Hello, welcome to my channel once again. Thank you for uh, checking out the videos I upload every time on the channel. And if you're just seeing this my channel for the first time, do well to subscribe. Click on the subscribe button so that more people can have access to the contents in this channel, and also the like button so that more people also will get to see the videos. Now, let's go into tutorial. So this particular video is about market structure. I want to really start a series for people that are just starting out in the trading journey, and also if you have been having a difficulty understanding market structure, this video will give you all the information you need to know. It's a very comprehensive tutorial. So let's get right into it. We'll start by defining the different types of market structure that we have. Generally, we have three types of market structure, which are bullish trend, bearish trend, consolidation trend, or choppy trend. So let's start by listing out um, the various types of market structure. Various types of market structure. So we have three types of market structure. And by the way, what we mean by market structure is the way market structure is basically the way the price moves. So that is just basically what market structure is. It's the way the price moves. So price moves in these three ways: either bullish going up, or bearish coming down, or sideways horizontally, which we call consolidation. So those are the three major ways that price moves in the market. And understanding these things is very important. Traders of for forex and or currency or anything that has to do with charts, they agree on this point that market structure is king. Market structure is king. Understanding market structure will help your journey in learning how to trade forex or synthetic indices or crypto by 80%. So understanding market structure is very germane for anyone that want to excel in the forex or the currency market or crypto market or synthetic indices market. Anything you are trading that has to do with the charts, you need to understand market structure. Very important. So let's go right in to the first bullish trend. So bullish trend. So let's talk about bullish trend. Bullish trend. Now, when you see price, when you see price moving this way, when you see price moving this way, we say the market structure at that time is bullish. It's a bullish market structure. Bullish market structure. So, and this is, we tag here this point here as the low. Tag here as the low. Then we tag here as the high. As the high. Then here is the higher low. Now, please, I want to encourage you. Now, most people, they start off a video, but they don't have the discipline to watch to the end. You will not be able to get the meat of this tutorial if you just skip the videos to the end. No, to learn, you require patience and commitment. So discipline yourself, make up your mind that you will watch from the begin to the end of the video so that you understand, because there are so many things I'll be information I'll be passing across as I explain this each point. So please do well to watch from the beginning to the end. Even if you can watch it at 2 or 3 times, it will be even better for you, so that you will get the meat of the lesson. So don't be like the many people that just skip through videos. So here is the higher high. Is the higher high. Now, quickly, Why is this place called a higher low? Why is this place called higher high? Now basically look at this. This is a low, the low. This is the high. Let me bring it down a bit. Now this place called higher high is basically that this point here is higher than the previous low. That is why it's called a higher low. There's no rocket. It's not a rocket science. It's just simple logic. Now here is high. Now this peak here is higher than the previous high here. That's why it's called a higher high. That is just the logic behind it. Now here also this one is higher than this. It's called a higher low. This one is higher than this. It's called higher high. Basically that is why how this is are named, are labeled. So there's is nothing special about it. There's nothing to cram about it. It's just that simple. So let me just quickly do this for reference purpose so that you can have something to write. So the L means low, H means high, HL it means higher, low, yeah. Then HH it means higher, high. So basically that's what those words means. So now there's something vital, please. You must take note of this. You must take note of this. You must take note of this. Look at this. A higher low in a bullish trend is not valid except a higher high is formed. A higher low is not valid until a higher high is formed. In other words, if price does not move above this previous high to create a new higher high, you cannot say this point here is a higher low. Likewise here, until price moves from here and breaks above the previous higher high here, this higher low is not yet valid until there's a higher high formed. So a higher low, please note this, a higher low becomes valid when a higher high, a new higher high is formed. So that is something you must really note. And for a bullish trend, the higher low here is called the structural point. It's called the structural point. Here is called structural point. Here is structural point. Now I will talk about it in the when I'm through with the remaining the other two, the importance of structural points. You must please do well to watch to the end of this video so that you will understand this the importance of structural point. So let's go to the next one, which is the the bearish trend. You need to understand this bearish trend. Now, beautiful. Now the bearish trend is the opposite of the bullish trend. Sorry, it's the opposite of the bullish trend. That's something like this. So this is a high. This is a high. It's a low. So guess. So what would this be? Did I say lower low? Yes, you're correct. So here will be the lower low. Lower low. This is the lower low. This is also the lower low. Don't mind my drawings. So here, likewise, it's called the lower high. It's called the lower high. just like the bullish trend, it's called the lower high, was just the opposite of it. Lower high here, lower high here too. Sorry, and lower high here. So basically, now, just like the bullish trend, this is the bearish trend. This is the high. This is the low. Now this low high means this point is lower than the previous high. Lower low means that this point is lower than the previous low. Lower high means this point is lower than the previous high. Just like that. It's not rocket science. That's the idea of this. So let me really write out this so that for record purpose, so that you can have it anytime. So this is L is low, H of course is high, LH is lower high, um, LL is lower low. So basically that is that. So now for the bearish trend, the lower high structural point here, this structural point here, lower high, is not valid until a lower low is formed. A lower high structural point here is not valid until a lower low is formed. So until price forms, breaks the previous lower low and gets a new lower low before this particular one will become valid, except price breaks above the previous low here to form a new lower low here before this lower high here is valid. Very important. And this lower high is called the structural point. So let me mark this with let me call this so that it's for you for so that you use it as a reference. It's called the structural. It's called the structural point. Oh, I took the wrong label. Sorry, please. Let me use notes. No, no, leave alone. It's called the structural. Sorry, structural point for a bullish, trend. So this is the structural point for a bullish trend here. Let me change that color. Let me change the color of the text to green, since we love green to be bullish. Okay, so why here is the structural point for a bearish trend. Please, very important. So all here structural points, are structural points. So I said I will explain the importance of these. I will explain the importance of structural points when I finish on the three of them. So this is how a bearish trend looks like. Now the third one is consolidation. 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 Guys, if you have not subscribed to this channel, it's time to click the subscribe button so that others can also see this, just like you got to see it too. So let's continue. Consolidation or choppy um trend. Yeah. So look at this. when when you see the market doing something like this, something like this, something like this, when you see the market moving this way, we say this is a choppy or consolidation market. For retail traders, they will say here, they'll say here is the resistance. They'll say is the resistance. Let me turn it to red. For this for um retail traders, they will call that place resistance. They'll call here the support. They'll call here the support. And change it to red to green. So when the market is moving this way, we say it's a uh, consolidation trend or topic market. So these are the three ways market structures are on any chart. It's a market is bullish, either the market is bearish, or the market is choppy. So so now, but me, I trade smart money concept. For we smart money concept traders, we don't call it resistance or support. We call them with liquidity. But that's another topic for another video. So if you subscribe to the channel, you have a chance to see those video on how to know liquidity and different type of liquidity that we have. Okay. But let's continue now. Now remember, I said this this point is the structural point for a bearish. This point is structural point for the bearish. This point is structural point for the bearish. This structural point. And I said um, the lower high for a bearish trend is not valid until a lower low is formed. And I said a higher low is not valid. The structural point higher low is not valid until a higher high is formed. Now, what's the importance of structural points? Notice something here. Look, as price moves from the low to the high, down a bit by retracing a bit and going up again, then retrace a bit, going up again, you will observe that price does not clear out the previous higher low. Price does not clear out the previous higher low. Look at it. It does not clear high for a bullish trend, does not clear out the previous higher low. For a bearish trend, it does not clear out the previous higher high. So this point is the best place to place, for example, for a bullish trend, the higher low is the best place to put your stop loss beneath it. So for example, if you're to enter the trade from here, from this point here, the best to put your stop loss is below this previous higher low. If you're to enter a trade here, the best way to put your stop loss will be below this previous higher low, because if it's a bullish trend, price never gets back to the previous higher low. That's the power of structural point. Price will never get back to the previous higher low if it's a bullish confirmed bullish trend. Likewise, for a bearish trend, the best place to put your stop loss is above the previous lower high, because price will never get back to the previous lower high if it's in a bullish trend. So that is the power of these structural points for both bearish and bullish trend. Very, very important. So I don't know if you it's very this is very this what I just told you is a very huge secret. If you put your stop loss anything above it, the likelihood that price might come and clear your stop loss is very high. But the likelihood of price coming back for a bullish trend to come and clear out the previous low is the probability is very low. So this is basically market structure at its best, as simple as this. And listen, don't make trading complex. Trading is easy if you don't complicate matters. So click the subscribe button and the like buttons, and see you on the other side for the other parts of the tutorial. Bye for now.